All right, Michael Kelleher, take me out to the ball game. We got a baseball starting time today.
Yep, we do. It's 3:05 Eastern. I was out at Housing Wire. As anybody knows or follows us now, all of these episodes are now recorded and they are put out on our YouTube station every Sunday. So we used to say maybe a little bit edgy items and they were not recorded. Now we just say edgy items and they are recorded. This is MoreTalk, mortgage, real estate. And today we're going to get into maybe finish some talks about digital mortgage, talk about Housing Wire, talk about the upcoming MBA annual. And Michael Zano is going to get into what a lot of, I think the theme, Mike, from all of these is this where rates are going to stay? Is this where rates are going to stay until the third and fourth quarter of 2024? Or are we going to actually see some sort of rebound earlier that's not just purchase driven that customers should be ready for? And then it's AI, where it used to be blockchain.
Yeah, that's a lot of info to pack into one comment. So let's just start out with your elephant in this past week's room. And let's start with Housing Wire Annual 2023. I mean, first of all, before we even get to the show, what was the airport like for you? Because I'm just curious, with the stuff that was going on over this last weekend. Because I flew out to Phoenix for the day to go do something on a mortgage loan, and the security was like completely uptight from San Diego to Phoenix. So you getting to the airport in Boston, highly trafficked Logan International. What was it like to get from Logan over to Austin?
Yeah, now that you say it, the line was longer to get past security. This was one of those incidences where security made sense. Obviously, with everything what happened, heightened. It was also one of those where, as I travel around, sometimes having TSA pre-check always does usually work, but this was one of those times where it really worked. There was 4 people working the TSA pre-check, and I was able to get through really quickly. It looked pretty tight in other places, but I didn't notice it too different. Given everything going on.
You're not going to believe it, but TSA pre-check was longer than the regular line. I was in the line at TSA pre-check, and then I said, you know what, I'm going to go to regular line. I'll just take off my shoes and laptop and coat and all that other stuff. I beat the lady who was in TSA pre-check. So it's like, that's how busy it was at San Diego. It was kind of crazy. But then, okay.
Yeah, that's what I'm saying. That does happen when you travel, and it's baffling. But don't let it fool you. There are times where, without a doubt, the TSA pre-check is the savior more often than not. Got into Austin. I actually had an experience where you take things for granted. I take a lot of Uber rides everywhere, every time I travel. And I take them while I'm visiting the clients, while I'm going to dinners, to and from the airport. We were out on a ranch type of really awesome, intimate client, which I can get into in a minute. But when you are off the grid that far and you need to get to the airport in ways of convenience you're accustomed to, and then all of a sudden it says, your Uber driver's 19 minutes away. I got into the Uber knowing it was limited anyway, but about halfway through the drive, she's on the phone. First, she tells me all about this stressful situation of being a home buyer and not being able to get the money because the bank doesn't believe in them. They've been on time for 7 years as renters, and unpack that. But then she's taking phone calls like while we're driving, and she's tailgating behind these trucks that you can't even see if the highways there sort of they have lights, like red lights, and you can't see around it. I don't know what's going on. And then she takes a call from her car insurance company trying to blame a hog for running into the car. You couldn't really make it up from, and I'm not trying to be funny. I was actually fearing I know statistically, I knew I was probably in a bad place. Like, car accidents are probably more dangerous than being on the airplane, right, to begin with. And the people that get in them are probably the people that drive 30, less than 20 feet behind somebody going that fast. So you take it for granted that these Uber drivers are good drivers, and They don't have to go through any driving class. They just need a good driving record. So there's my
that sounds like almost sounds like what it takes to be either a realtor or mortgage originator. But anyway, I digress. So how was the show? I mean, was it well attended? I mean, and what was the talk like? I'm just curious. I mean, for me, after going to Western Secondary and seeing it fairly well attended, but that's mainly California Association. That's the CMBA, right? So how was Housing Wire on a national level? Because we got the MBA coming up in Philadelphia, and Housing Wire Annual is more like a precursor to the MBA. So how was it attended? And what was the conversation? Was there that many C-suite executives that were going there that would cause enough commotion to warrant it? Did you see Kevin Peranio? So that
I hung around with Kevin. I hung around with Kevin for hours because there's nowhere you can go. And so that's 2 years in a row Housing Wire has done this. I'm not sure if they're doing it next year, but they chose a place where, one, because it all is more of a resort type, the rooms are not inexpensive. So most of the people that you have there are, serious about being there. The speakers they have a lot of C-level speakers. So they have a lot of top chief marketing officers, chief marketing officer guaranteed rate, chief marketing officer of Loan Depot, head of sales of American Pacific Mortgage. They have the top 2 loan officers in the country there, Shant. From Guaranteed Rate. Got to spend some time with him. Got to spend some time with this guy is a brilliant person when it comes to process and understanding what he wants to do. He runs the Loan Factory.
Oh, interesting. Okay.
And he's been the number 1 for the last couple of years, actually, I believe.
Wow. So actually, it was a good mix of I mean, not just like, ancillary services looking, like, all these vendors and nobody actually to buy our vendor services. But actually, if you were a vendor going to Housing Wire Annual, you had a chance to potentially cold market someone. I mean, that's a terrible way of saying it, right? But you just say, hey, how's it going? Get a random conversation and potentially schedule a secondary meeting off of the event itself. So that's good, right? Because that's actually a good sign as a precursor to the MBA. So if you're another ancillary service, and whether it's appraisals or something related to financial planning or something like that, it's a good way to actually get C-suite level people to potentially get their ear. So that's good to hear. And did you? Now, was that were you there from beginning to end, like just like a few hours prior to the actual event itself? So you had a chance to actually go and meet and greet, or did you have a whole bunch of appointments set up, or how did that work for you?
So good question. I was attending a lot of what they were offering. I found that to be successful at the Housing Wire. Whereas, at MBA Annual, I have about 17 meetings. So there's no way to go to anything really for me. And I got there a little bit late, but I heard Logan Motoshami, who I got to see quite a bit there, right? But he did a outstanding job of saying where the market is today, and outside of lenders being in a recession, the overall housing market is actually strong when you factor in delinquencies, the amount of delinquencies, when you factor in the amount of equity that has gone up. I think he said it, and they reiterated it over when one of the Keller Williams came up there. But it's still going to be the fourth highest real estate by volume, right? Year. So that's strong on the real estate agent side. It's the lack of transactions, I think, that is more the problem on real estate. And it also goes with a lot of the message there was like, the winners are the winners. Or the winners are going to just keep getting market share right now. For this market, this is actually a good market for winners. They got there by working hard. They know they're going to have to work hard. 95% of people won't work hard, according to Shant, in this market or in any hard market. and 5% of people will. He's going to be one of those 5. Now he has money behind him to not only be those 5, but to amplify it. That's my big message with Adopt the Brand and the Jeff Zimfer, Michael McAllister program I'm working on. You need to get out there in front of realtors now and have those classes, and then have the retargeting strategies for them to remember you being there during these times. And then I think it's vital. Yeah, I mean, I could keep going. There was a lot of great messages. Taylor Stork made a huge push on what it's like to, be running a mortgage company, not necessarily at retirement age. So how are you going to build? How can you run a company today to build a future for tomorrow? And don't just hope, there's another dip in rates to maybe go off into the sunset. How can you build it around home ownership? And home ownership, obviously, there's a big problem with how you get, people buying homes, first-time home buyers, all of that unit talk. But from a volume talk, it's still very strong, right?
Yeah. So let's backtrack one conversation a little bit. So, I mean, we have an inventory problem in the United States. In other words, like there's just not that many home sellers. Number one. Number two, there's because of the strong employment economy, or at least that's what it looks like on the surface so far. It looks like that there's just not that many mortgage delinquencies, and actually it looks like that's going to continue because as banks still have high amount of consumer savings relative to the households that are out there right now compared to like 10 or 15 years ago. Savings are still much more higher than it was now compared to 15 years ago. So, if no one's selling yet because they still have savings in the bank, and no one's selling because the economy is still strong, I mean, Chance says he's going to continue to grow and stuff. But what does that mean for the bottom tier originators? Was there any talk at all about how there's going to be a potential, maybe not exodus, but I think that Jim Deitch may have bridged on it very briefly at one point in time, basically in his Moneyball scenario. Are we going to be losing originators because of the lack of business? And as a result, a lot of these originators aren't even members of the MBA anyway, so it's not like they're paid members, and so it's not going to affect the MBA. But is that also a potential of increasing market share as well? Was there any talk about that as far as losing originators in the business? I'm curious because, there was a lot of
talk about. I'll give you some examples. There's only 80,000 loan officers that did one deal a month for the last 12 months. There are 200,000 that did less than that. And a lot of the lenders were saying, in order for them to survive, they need to better utilize the data they have in front of them every day, which was the equivalent of really being a tough manager, meaning you have your locks for the day. You should be meeting with everybody in this market and going over where did they come from? Were there any concessions with them? Then aging, which ones have been sent to processing, which ones are in underwriting, and going through that daily to get a better aspect. Like why you're not doing that was one of the big messages. And you need to and I think people are scared to create one of those environments where people don't want to work. And, somebody talked about having to get rid of a top producer, did like $40-50 million a month. And they found out they weren't that profitable after.
Well, I'm curious about that. I mean, what does that look like for an IMB? Someone who's doing $8 million a month, let's say, and they're sitting there going, you know what? I know that you're profitable as a company because you're funding $8 million, but because you're this team and you've got 2 assistants on your team, it looks like we're losing 50 after everything is said and done. We're losing $1,500, $2,000 per origination per unit on you. And so, if you're going to get recruited, go for it because you're asking for more pricing exceptions so you can get your $8 million, but your comp at 75 basis points is the same. So go have fun, go for it. I mean, does it look like that type of conversation with the higher tier originator actually may, does that look like it's going to be more of a truth than fiction?
But people that have done it are suggesting others do it. When they fired that person, they said, you know what, he wasn't a nice person. And they didn't realize it, but they've made up the volume. And some recruits have come over and said, I never came over because of that person. They had no idea. And then everybody was able to work more because of, the stress it put. But at the same time, you have a lot of lenders that are keeping around people that only do one deal every 3 months.
A lot of lenders? I mean, define that. Like 200 lenders?
200,000 people have done less than 200,000 loan officers have done less than one deal a month for the last 12 months. But they don't require health insurance. They don't take a draw. They're technically profitable. It's the fact that those are the squeaky wheels, right? Is what they talked about.
Sure.
Because every paycheck matters to them, right?
Yep.
So they're going to be the ones pushing it. And does that cause a problem? I think you used to be able to use. There was a lot of talk about vendors having to go from a seat model to try and find out ways to close because of those people, in this market. But I think like you've been a loan officer on the other end.
Yeah.
If you're doing 6 deals a month and you don't take any base or any health insurance, 6 deals every quarter, and you took, one cost to cure out of those 6, do you really feel like you're not profitable? Aren't you asking yourself, how could I possibly be not profitable if you're not paying me health insurance? You know what I mean? Is it my fault that I think one of the big faults is not fractionalizing underwriters in this place, right? So if an underwriter has a capacity of 32 underwrites a month,
32
say,
fundings,
right?
or 32 fundings, or 32, loans to touch. They better be touching.
You tell me. I don't want to be way off. Somebody from the audience could tell us the right answer. But let's say it's 32.
All right.
Well, if they're only doing 24, what I'm saying is if you can't have half underwriters, right? The model's technically broken. Somebody's going to say you should either cut 24 loans a month in production from your loan officers, or just let that extra person stick around for 6 to make sense not to have to get rid of that underwriter because you might need them when things go back up. And that was the message. Cut. Unfortunately, this wasn't a message from everybody. One of the people said, cut, because there's so much talent out there. When things turn around, it's going to be so easy to find the talent first to get it there. And so you won't have the pains that you think you will. But if you don't cut enough, cut enough and rates get worse, you will have the pains.
Oh, the pain's going to happen. And I think that any C-suite executive who thinks that the people are going to be out there and they're not going to look for gainful employment, they could be a processor, a doctor, or whatever. And, you think I'm going to wait around 8 to 14 months for you to call me back and say, hey, I got a job for you at a little bit less than what you were paying me because you took a loss in the last 14 months? No, I just took this job over at XYZ dental, medical, industrial job that pays maybe a little bit less than what I was getting at the mortgage company, but I have a job for the next 14 months and forward. And I can actually qualify for another house versus like, I got to wait for 14 months for you to pay me. No, I don't think so. I think that
I just got a car because my lease was up. Right. And the gentleman found out, like, what do you do for work? I said, I consult mortgage companies on how to make more money in sales and marketing and do it at a lower cost. And he was talking about how, they have 4 or 5 people that left the auto industry for mortgages a couple of years ago that are all trying to apply for sales management jobs there that are currently working as a loan officer. So,
and are they getting jobs at the auto dealers? Because this is what it's going to look like in the mortgage industry. So are they getting their jobs?
I don't know, but I don't think those are the people that do enough business right now, right? Maybe they were okay, but I think what the lenders really want is that person that runs a team that can bring over a team of people that are accountable, have processes in place, and are able to go out and get listing agents. Because that's the other big topic. Are we going to lose 80% of the realtor business model of buyer's agents?
I don't know. It's going to depend upon like what is this? NAR wants to change the contract. I'm going to change the topic just briefly for a minute in here, but NAR's wanting to change that topic where now that the buyer is going to be paying for the commission, so now they got to pay originations to the origination company plus commissions because the seller's not going to pay the commission. I mean, because if you're the buyer's agent, you have to write seller is going to pay for the buyer's commission. So like, so if it's, before the cooperative broker agreement collectively might have been $50,000. Now it's down to $25,000. And then you're an agent saying, oh yeah, be prepared to pay another $25,000 to double this because of XYZ reasons. I mean, there's a few more moving parts than just employment that's going on here, I think. So
yeah, you can follow Ashley Tyrell from, I think I said that correctly, from milestones.ai. She does a great job of explaining it in the last couple LinkedIn posts. She was out there. They threw a great event at Housing Wire Annual. They have a strong presence. She can give you the exact reasons. The way I interpret it is, you as a buyer sit down with a buyer's agent right now, and they explain, you don't have to pay me anything because I get half of all the sales half the commission from the sales. It's not even going to cost you anything, and I have a fiduciary duty to you. They will now have to say, if the seller's not willing to pay me a commission, then you are going to owe me XYZ. $3,200 is my flat fee to show up to 20 homes.
Okay.
And then you would say, where does that $3,200 come from? And I would have to say, your pocket. And that's, I think, why it was an easier sale last time, because they would say, don't worry, it's not going to be out of pocket, right? It's built in. Right. Everybody does it. And I don't get why it supposedly protects the consumer so much, but obviously this does. They feel like it'll open up ways to make it less. So we'll have to get we are going to start getting some guests on, November, December here, Mike. I said, I think that's going to drive a lot of traffic up here. There's no real traffic here because we had some problems with the event, right?
We start.
I don't even think it's a different day, different start. It's also the event I did accidentally had yesterday's date. It must have been a central time problem that I ran across. So this is a brand new link on LinkedIn, at least, where we get our audience.
Got it.
But those that usually come, we're always 2 p.m. Eastern, and I'll be around 2 p.m. Eastern next week, without a doubt.
All right. So next week
we'll get some interviews and ask, because why did who was the one that settled? Was it, I always mix them up, Remax or Keller Williams?
Oh man, I don't remember. I think it's actually Kelleher.
Okay. They settled for $59 million. They thought it was such a good deal. I guess this is like a huge deal. They even paid cash for that.
I believe
Anywhere settled for $87 million. They're going to keep going up though. And NAR still needs to settle. And so when NAR settles, that'll be the big one. Because when NAR doesn't allow sellers to write in buyers' commissions into the MLS, that's when it's all going to change. They just haven't settled yet. And part of the settlement is that.
Who's that settlement go to? It's not like none of it goes to the consumer. They're all, is it what?
Lawyers.
Of course, right?
That's what the realtors are saying. This is all just going to it's not good, but technically it would go to, like when Facebook did it. And remember, everybody called around and said, do you want like your $61 if you had Facebook since 2015?
Yeah.
I think they would call anybody that's closed a home in the last decade and say, do you want $24.30?
And yeah, that's not going to happen. It always goes to the lawyers.
Well, that's what happens. These commercials will come on TV, right?
Yeah.
And they'll say, have you closed a home in the last 10 years? Did you use an agent? Did you close with XYZ? You might be entitled to a settlement. And that's what that is, I believe. But
let's not digress. Let's step away from that and let's get back to Housing Wire Annual quick. Is that okay with you?
Yeah.
All right. So I was really curious. Did you happen to go to the breakout session with Sandra Thompson, FHFA? Did you listen to her? I actually, Housing Wire had her on the podcast. I hadn't had a chance to listen to her yet. And since she was there speaking, I was curious on, first of all, did you get a chance to listen to her speak at all?
I did.
And did you get any takeaways from that at all?
I got nothing new from that one.
Okay. Outside of that, was there any?
They want to push for, down payment assistance and how do we get people into more first-time home buyers into the market. But it's not any different than, where her stance has been in the last couple I've gone to. When she spoke last year, people are like, is FHFA going to get rid of PMI? She said maybe, and since then they've lowered it, right? Like there was actual really good pieces coming out of her talk. Right now.
You're talking about HUD lowering their MI rates, is what you're saying. Not the FHFA, but actually FHA and HUD.
FHA HUD, right? Yeah.
Got it. Right.
So that was last year's Housing Wire Annual, and she gave away 3 nuggets of info, or they all did.
Well,
this one, I don't know. It's we're kind of stuck supply side, and I don't really see what anything she added is nothing everybody's not aware of.
That's interesting. I mean, for me, over the course of this last week, I was doing a little bit of research, Michael. I'm a step away, but I haven't seen this many requests for short-term bridge financing on affordable housing projects and for construction loans, that is. I mean, like, I'm in the middle of like 4 of them right now. Like, I'm not even in the I mean, I'm like doing one non-QM loan. I just happen to be, because a past client was begging me that I do it regardless of what the comp was. And I'm like, okay, fine, I'll do it because it's non-QM, and my current broker of record said he'll sign up for a non-QM lender so I can do this one loan. But other than that, I mean, I just switched all the way. And what's surprising to me is the amount of waiting lists for affordable housing still, and the fact that that these builders are putting up, they're breaking ground. It takes about 8 to 12 months, depending upon the municipality they get their permits from, to build affordable housing, and that how many people are still willing to rent. I mean, lines on, hey, we're not going to be ready to rent to you for 8 to 10 months. That's fine. I'll get on your waiting list, and here's a deposit for the waiting list to rent. And then talking to a few even higher dollar people here in San Diego County, I'm talking to people, they can plunk down, $400,000-$500,000 for a down payment, and they're like, yep, sidelines, we're going to continue to rent. And I'm just surprised because, I keep telling people, the market's not getting any better as far as supply is concerned, and you still want to wait, even though prices could go up. Well, I want to wait for rates to come down. I'm like, wow. So this demand, this whole lack of supply and the continued demand, it looks like to me, at least from the San Diego, Arizona, Southern California, Arizona, who I talk to a lot of people down in these two areas, Phoenix, specifically Phoenix. It looks like there's the type of demand out here in the southwest portion of the United States is still going to be high. I don't know what it's like in the New England area, but we're going to see continued demand. So if we don't see more opportunities for affordable housing, that level is eventually going to get aced out. So I will be very curious to see if there will be more affordable housing, some kind of subsidy.
I think we have the same problem. It is a backlog of being able to get those projects launched off the ground. But there's also a frustration that under affordable housing, you are able to get projects that shouldn't be approved, within towns and municipalities. They get approved by being, meeting the 40B requirements. Maybe there's not supposed to be that much explosion in that area to break ground, or certain size trucks shouldn't be going down the street, or it shouldn't be that high. These large conglomerates are going in, buying it from the local developers. They have enough lawyer money to get it through, and the state has to approve it, or that's how it works. So I am aware of it. We fight for both sides at the MMBA.
Sure.
And I think that's a great idea. I think they're looking for those ideas. When we visited with Elizabeth Warren, she was asking, do you know any of these ideas, like you're saying, that are working across that we could actually reference? But I will say on the other side, I don't find solutions like that, I guess, when Sandra is saying them, as breaking, right? Because I know how long it's going to take. Like, is there anything around the corner that sounds like it's going to help out the IMBs that are struggling? Or is there anything around the corner that is really going to unlock all this problem? Some quick facts. People love facts. 78% of all mortgages in this country that exist today were originated in the last from 2020 to 2022. And of those, 94% of them have a rate of 2.25 to 5.25.
From 2.25 to 5.2. Okay. Wow.
Okay.
That's crazy.
The result is last quarter, 82% of all refinances were cash out. Only 18% were a rate term.
Of refinances.
Mm-hmm.
Yeah, but refinances are only 18% of the market, 20% of the market right now. The other 80% is purchase business right now, right?
So there you go. So if it makes up 20% of the market and only 6% of those are rate term, right?
Mm-hmm. But when you say cash out, does that include? I don't know if that's HMDA data, but does that include HELOCs that are being taken out too, or is that only first trust deeds?
I would assume that's HELOCs as well.
I don't know. Actually, that would be. Yeah, we need to ask Ralph that question. Actually,
did you know? And I could try and get it from the source that I had it from. But did you know in Texas you can only take one cash out or HELOC for a house for the lifetime of the house?
Texas cash out rule.
That's what's called, the Texas cash out rule.
My parents live in Plano, which is a suburb of Dallas. They refinanced their house, I think, once. They did a rate and term, no cash out, less than $2,000 back. In fact, they paid it down when they refinanced. But yeah, I mean, but I wonder, does that also include HELOCs, or is that only on
Yes.
first trust deeds? That's interesting.
Well, especially with this big boom, right?
Well, I mean, if that is the case, then why isn't that producing more refinances or sales for certain people? I mean, I would think that I would turn my property. I would turn like one property into like one investment and one owner occupied, just to reset that one clock if I'm living in Texas with a California mindset. That is right.
I knew you had good ideas, and yeah, that's why people come here, thinking out of the box finance wise.
Well, yeah, right. Like, you bought your house in Plano in 2004 for like $300,000. It's now worth $800,000. You're sitting here going, "Well, I did my refinance. I took $50,000 to cash out, so I blew my wad there. So what am I going to do? You know what? Let's sell our house for $800,000. We'll buy another property similar. We'll buy the neighbor's house for $800,000, but instead of plunking it all the way down, we'll raise our mortgage payment, but the rents have gone up so high. We're gonna stay in Plano, and we're gonna buy a $400,000 house in Richardson, which is one city over, but still a relatively nice neighborhood. Still middle income, high middle class area, and rent it out. And we'll rent out that place for $3,500. And we'll cash flow on it because we're going to put down a big down payment to make up for our payment here. I mean, there's ought to be all kinds of financial toolbox ways to do that. I think that maybe the average mortgage originator just doesn't educate themselves on the financial literacy portion of it. They just look at Mortgage Coach and say, yes, this is how much you're going to save on taxes by this one transaction. It's not really designed to do multi-real estate transactions, at least in my use of Mortgage Coach. It just wasn't useful enough to go, okay, we're going to do this one. This is the cash flow. This is the tax benefit. And in 3 years, this is what we're going to do. Mortgage Coach is actually not designed to be a financial planning tool. It's just designed to be a sales tool. And I think that we're not at the point on a fiscal literacy level to be able to teach the average consumer what it actually means like to be a real debt advisor versus just, I know that the Dave talks a lot about being a debt advisor for life and the mortgages and all that other stuff. And he's definitely on the track of the right direction, but it's not currently designed for actually saying 3 years from now, 5 years from now, buy the next property, cash flow, tax benefit. This is how you're going to do it. Work with your financial advisor because they use Redtail in order to do their CRM and so on and so forth. And it's not, the mortgage software doesn't communicate with the financial advisor software. They haven't developed that yet. And for me, working with financial advisors, it just doesn't have it. And this is all related, of course, to the financial literacy of, I'm going to say it right now, if the first time home buyer really said, I'm not just going to buy one home, but I want to buy multiple houses over the life of my life, then this is how I think I can do it. Instead of just, I'm not just concerned about the first house. I'm concerned about like 4 houses from now. I don't think there's enough education on that one because maybe there isn't the aggressiveness on financial literacy to do that. But anyway, I digress.
That was great. I'll fly through some more Housing Wire stuff for you real quick.
Yes, please.
So Cindy Keith, Chief Strategy Officer of NFM Lending, talked about how they've created waterfalls among vendors right now. So like in VOE, they start with the least expensive vendor and then have to waterfall it all the way to the work number if it doesn't hit. And that allows them to save up to $100 a loan. So looking at multiple vendors and can you write a way to start with the cheapest and go to the most expensive? I found that interesting. Sarah Gonzalez from Panorama Mortgage talks about the importance of having your own captive BPO, which is what I do. One of the things Adopt the Brand does, are very highly involved with OPX, and would love to talk to you guys about that. But like I've talked with her at length. They have their own captive out of Mexico. She could talk about how long it takes. You can't just go down there and do it. But what they're able to do by having that in place, she said, is a significant advantage from a cost perspective and from being able to scale in the future. And Jennifer Hedgepeth, COO of DHI, number one builder right now, just talked about how they are there are these extremely high numbers for Ron, but they want to get completely digital, like 99%, next year. So that's really what she was working hard on. Then Steve Cooley ran a great one with the marketing directors. Arjun, who has a great at All Western Mortgage, great branding on Instagram, talked about that. Steve Cooley was very funny, talked about KPIs. One of the things that stood out to me was Samantha McKendrick pointed out that she found when they were cold calling, she's a vendor. So when they were cold calling into lenders, only 11% of them knew who the brand was. And by running retargeting Google, Facebook ads against that list, they were able to get it up to 50, 60%. So just something to think about. If you can run that in your database in anything you do, and that's what we want to talk with lenders about, just be focused. Like if you're going to be doing realtor classes, when you call on them, you should already have run ads against those emails. Very inexpensive too to do that. Alex Hansen, Chief Marketing Officer at Loan Depot, he just has such a good grasp on what the loan officer is going through, and then how important it is from a marketing perspective to provide that delightful experience, be that brand that people recognize. Talked about the difference between like Nike and a Hyatt, right? Like what the Nike brand is, and he actually talked about the smile in the packages that come from from Amazon.
Sure.
On the boxes that we see all the time.
Yeah.
And he pointed out that he said, I wonder why we got all these smiles, why they send that. And his wife said, because they have everything from A to Z. That's why it's an arrow smile from A to Z. I didn't know that. I thought that was pretty cool. But he had a great presentation on a lot, like what a lot of them said, like getting back to basics.
So do you think that with the marketing breakout sessions that were at Housing Wire Annual, out of those marketing sessions, do you think any of the C-suite leaders that are in the independent mortgage banker space, do you think any of them came to it thinking, I may come out with an idea, I may collaborate with some of my IMB leaders in order to figure out how we're going to actually come out of this with as little damage as possible? Or do you think that there's still there's kind of a still wait and see, but during the headlights attitude that the leaders of the mortgage bankers are just hoping that rates get better and that as a result they produce more profitable business and things like that? Or is there like a collaboration somehow? Instead of commiserating, is there a collaborative? Is there a way to do more collaboration than commiserating? Commiserating meaning that you're just like feeling sorry for yourself as a C-suite leader, and collaborating meaning like I'm gonna figure out how to pay more to collaborate in order to be a more successful independent mortgage bank. Because
you're going to see a lot of cuts from October 31st to December, for and you're going to see a lot coming here in November to get ahead of the holidays.
Mm-hmm.
I think they are collaborating with each other.
Wait. The same way that Sprout did it, or just, kind of like, hey, sorry, too bad, and let you go, and I'm sorry you're going to have a bad Christmas? Or is it going to be like, we're going to let you know now that something's coming? How do you think that's going to turn out?
Oh, like the timing? Like, I just think the timing, you can say it's because of Hanukkah or Christmas or Thanksgiving, but that's just the quarter we're in. Like like November, December are horrible in mortgage to begin with. The fact that for real estate listings, it's going to go down to 276,000 a week, new listings each week.
Oof.
That's less than, I think, the amount of loan officers out there, right? So
yes.
They're going to cut the people that they didn't want to have to cut, I think. And they are collaborating in that effort of how to do that and how to maybe figure out new product. Seems like there was a lot of talk about new product, but they understand that educating the loan officers on new product is so hard. Getting them to show up is so hard. And I think what they're missing is, and where Adopt the Brand is going to help in 2024, is there is that collaboration that they need to have with marketing and what they heard out there in marketing, and start to outsource, I believe, to a company like OPX. Get that out of your head of, let somebody be in charge of managing that project and managing that division, and have a captive, meaning the outsourcing is your group. It's just a global delivery system. And I say a company like OPX, let them work on sort of helping you manage it so that you can go out and get your chief marketing officer realigned with your sales team, and how are we going to use new ways that work in this new business and not old ways that work. So, I can't say enough. You go out and you find a tool like FinLocker that Brian has, and you don't just quote sign up for it. You need to figure out a way to retarget that to the people that you're calling before you're calling them and after you're calling them, and then have systems in place like EmpowerLO or EmpowerLO Supercharge with Jeff Zimfer to get real estate agents. But just in general, you need to have a plan on before you call them and what happens after you call them, and you need to focus that plan on the loan officers that you really want to get to the other side with. And by doing that, you'll show them that you're invested.
I've been playing around with FinLocker. I'm on it probably every other day trying to figure out different nuances and stuff. That's a product that if the banks, I'm not talking about the IMB, but I'm actually talking about the bank, the Wells, Citi, Chase Bank. If they would actually use this, because they're being told to cross sell all the time. The banker, the guy who sits at the branch, not the small business entrepreneurial loan officer who works out of a home loan center, but the guy who's sitting at the branch. If they would actually learn and then utilize that and then tell the tellers and this and that, if they got something like FinLocker, that would be like the ultimate tool. Because now unfortunately, fortunate or unfortunate, however you want to look at it, depends upon which side of the fence that you're on, right? Because you can actually teach a whole lot about financial literacy when it comes to credit cards, car loans, personal loans, getting ready for home ownership, getting ready for refinance, even getting ready for refinances on a consumer level with the FinLocker app. It's actually super powerful at the bank level, because the average consumer / depositor who is banking at that level is actually, if they're, because they're using Zelle to deposit versus Venmo or so on and so forth, right? They got their local credit union app or whatever. That person is much more, because they're going to be at that bank level. That person at that bank level, the originator, is much more potentially going to be much more successful than the originator at the IMB or at the broker level, because at the IMB and broker level, they're not being told to cross sell. So that's more of it's a consumer. Let's pay down your debt. Let's do this. There's just not that much cross selling involved, because they're only involved with the mortgage side versus the banker level, which they're actually learning to cross sell other different types of products for the branch manager, and they want deposits and all these other things that are causing profitability to the branch itself. And I think that there's a huge opportunity potential for the bank originator to use a product like FinLocker versus Mortgage Coach, which is nice too. But I think that type of product, if the IMBs were truly able to say, we're going to really buy into the financial literacy outside of Mortgage Coach, then let's work on whole budgeting and savings and debt and credit score. I mean, like, that whole model right now works if someone's used to cross-selling. But when I see the average originator right now, and we're talking about first-time home buyers still, they're struggling to make the ends meet. They just want to close the sale. Most originators I talk to are looking to close a sale. They are concerned about the homeowner once they're in escrow. But that whole process of working with them, if you're only doing, one loan a month, and you're in California, you're only making, $4,000 a month on that one origination, and it's going to be super challenging to really want to work with like 7 people on that whole home ownership process, when it's possible that, if your IMB is not even going to be around in 6 months, are you going to be around in the same business in 6 or 7 months? And I think that, so my question, and asking that question back to the Housing Wire Annual is are the IMB leaders, Michael, looking to really attach themselves outside of laying people off? How much are they actually going to want to say, we're going to invest in the middle tier loan officers into their success, and we're going to really, really buy into other apps or other ancillary products and services, and we're going to align a FinLocker or a Mortgage Coach and Surefire and all these other whatever, so that they can produce more profitable business versus the top originator, and maybe work with a Jim Deach. Maybe, I'm not sure about that yet, but is there any takeaway for me to think that now that you mentioned at the very beginning that there are ancillary services at Housing Wire Annual and there is some collaboration, but with the breakout sessions, because I know that Clayton's going to be looking for some advertising dollars at the next Housing Wire Annual, are there going to be more collaborative instead of cutting people at that level? Is there going to be more collaborative opportunities so that other ancillary services will be purchased so they can produce more mortgage loans, so that because there's going to be financial literacy from the renters and then also from the sellers, so they can educate themselves. Hey, it is time to sell. I'm at Qualcomm in San Diego. 1,500 people just got laid off, and I need FinLocker to teach me how to get through my sale, to teach me how to get my purchase after I get laid off, so I can have $800,000 or $900,000 of savings, because that's how much equity I have in my house. I'm going to be a renter because I'm going to have $800,000 or $900,000 plus my $300,000 or $400,000 of stock options and so on and so forth. But this app is also going to help me push me to be the next buyer, to go buy my next $2 million house in 18 months to 24 months from now. I know I went on that rant, but is there something that's going to? So the whole point of that part, Michael, is there something that's going to encourage the IMB to invest rather than lay people off? And that's what I'm looking to find out, not only at Housing Wire, but I'm hoping that something could happen like that for the MBA as well. That's a lot to unpack.
Yeah.
Sorry.
I mean, the answer is no. I don't think. But I will say, like, Rick Rock did a good job of, what I'm saying is they're going to have to cut right now. Volume's down. They've only cut 18%, or they're 18% off of 2020 workforce. It's just not a big enough number. They need to, what Adopt the Brand's telling them is, your top 40%, you need to understand that they're out, not the banks you were talking about, but the people out there, the entrepreneurs. You need to ride that with a digital amplification, that these are the ones that are here during these times, because that's what they'll remember. There is a chance for the great ones to get market share. Renee Rodriguez talked about, everything that comes great on the other side of hard. And when you write a list of what you need to do locally to do that, it can be hard. But if you actually write the list of what happens and what your life's going to be like if you don't do it, you're often going to find that's hard too. So yeah, it's hard. Nobody said it was going to be necessarily easy, but you have to start, how are you going to finish today and how are you going to finish this week? And I think the lenders need to help show those top producers. Just close your eyes right now. If you're a lender, picture your third highest producer, and now picture them in the office right now of your top competitor, just did a tour, and now they're about to go out for some drinks here on Friday with the team to meet them, to show what it would be like to work for them. And then when you open them, think of what you need to do for that third highest producer in your company to show them that and that's from the TED Talk type that the realtor from, I believe it was, I'll have to look it up, but it's either, the same two. It's either Kelleher or the other one. I always forget. So, but that was powerful to me. If you can't keep your third best, you're in trouble. Like, obviously the first, but that third one kind of shows who you are as a leader going forward here in 2024. And I think the answer is you can't help everybody, but you need to help the new ones. The digital marketing is the way, not only to get more business, but to amplify the hard work they're doing in their community, while all the average people have pulled out. No mortgage company's a sponsor in the local Pop One or the local Little League. So you need to get those lists, and you need to be, every time they open up a YouTube station, at least reminded of it, that you're still there. Because at some point when this, people will need houses, etc. And if you're the only one in town, and you come out of this cycle, this is when you win market share. And as you're preaching to the loan officers, you need to help them digitally increase market share as well, and give them the tools to increase it, and make sure everybody's aware of it. And that's why you got to lean in on your chief marketing officers, but also just assume here. I'll leave it on this tape. Assume everybody is a little bit stuck in their old ways and is a little bit off on the perfect 2024 strategy, and then call us at Adopt the Brand and let us assist you in all of talking to these vendors, talking to these marketing officers, and just being the guy, the team that says, hey, 2024 might be different. This is what we need to do. I think it's that to answer your question, it's that simple. And next week we could talk about, Rick Rock talked about about ways you can make money selling other products around the home. And he went into at length, and it was pretty cool. Even a company that was there that he brought there. But this is an asset there are products to protect the asset, improve the asset. You should be part of that as well.
Yeah, there's two things I want to address next week, or at least on another show. Two things. The first one is, how is a company I'm going to name two companies. Let's say it's a small IMB in Michigan. I don't want to name anyone that's out there, but there's like a number of them. Versus a Churchill. I'm going to mention them because I think this is a good example. Churchill actually has branches in California, but if you're a small IMB in Michigan and you're opening up a branch in California, you're taking a loss. But yet the branch at Churchill, and the only reason is because I know Mike Harvey, who runs the one California branch out here, and his P&L is profitable. So
Mike Hardy, I spent a lot of time with him at Housing Wire Annual. See, it had all the big names.
Yes, and so if he has a profitable P&L. How does a smaller IMB from another who's based in another state like in Michigan, how do they recruit and teach their branches to be profitable in a California, Washington State, or a New Jersey? Because when I talked to one of the leaders of an IMB in Michigan, I said, "Hey, you're probably taking a loss if you open up in California." He goes, "Yeah, I know that." And I'm like, "You're the leader, you're the president of this IMB, and you still, you still want to do this?" He goes, "Yeah, because we need this California presence." I'm like, "Oh my goodness, you're crazy, you're nuts." And I'm not mentioning his name because I don't want to say their name, but I want to talk about how does someone get a hold of, like, not necessarily Hardwick, but Mike, the other Mike over at Churchill, so they can say, okay, this is how we can because I think they're open to collaborating. Or something like that. Because you and I have talked about that briefly, right, Michael?
Let's make that the subject then of next week. I think there's many people that would come to this show and say, how do we collaborate new business channels in 2024? Because it's about time, and the loan officer certainly deserves it, right?
Well, not only that, let's figure out how do IMBs collaborate instead of vindictively recruit off of each other and talk negatively to each other. How do the leaders come together and say, we got to come together, not just because we're members of the MBA, but actually we got to figure out how we can do this together, because as a business we're going to be struggling. Because I know that title companies are starting to do that out here in California, where they're like, okay, we need to figure out how to be collaborative rather than eating each other away. So can mortgage companies do that? So let's talk about that next week.
I love it. Another great show. And pretty soon we're going to have some call-in guests lined up all along the way, and that'll click to everybody. So another great show, Mike. I enjoyed it. I think people are going to love it on the replay.
I think so too. I'm
have a great weekend. The Friday special.
I know. I'm excited about that. I actually had a good week. I just signed loan documents on this commercial loan. So, and I got 2 more fundings coming up in the next week, which I was completely shocked. So we'll talk about that offline. Great show. Thanks, Brian, for joining us, and thanks, Christine, in Discord. And we'll talk. We'll see you guys next Thursday.